Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Spotify announced another set of changes, this time to its podcast business, cutting 200 jobs, or about 2% of the company's workforce. This is a continuation of the company's cost cuts and really a focus of its efforts growing in podcasts and advertising. So I want to go through exactly what was announced and the potential impact on the company long term. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And let's go right to the blog post that Spotify put out. This is the post from Spotify put up earlier this week. You can see that there's an update to Spotify's podcast business. That's really the way that they're framing this. And they go through a number of historical things here. Consumption growth up 14,000% since early 2009. Podcasts continue to increase in volume, and ad revenue has experienced high double-digit growth from 2021 to 2022. That's really the focus for the podcasting business. Ads is actually where podcasting costs go to. I'll get to gross margins here in just a second, but that's really the framing for this, is that for podcasts to be a successful business for Spotify, they're going to have to increase that ad revenue. A lot of what Spotify talks about here is the fact that they're going to put more tools in the hands of creators. So more analytics, more ways to build sites that are custom specifically to you as a creator, as a podcaster. It's going to be a little bit more like YouTube. So where you're watching this video right now, me as a creator, I have analytics that show a whole bunch of information about what people are interested in, what they're clicking on. That's the kind of information that's going to go into Spotify. So they're increasing the number of creative tools. The other thing that they're doing is rationalizing or cutting kind of the separate segments that they have. So at the end here, they go on and say that they're going to be getting rid of the Parcast and Gimlet brands and putting that under Spotify Studios. So really, a lot of these moves are meant to simplify what they're offering to creators and bring it all under the Spotify brand. So I'm going to just read a short section here. We recently embarked on the next phase of our podcast strategy, which is focused on delivering even more value for creators and users. This begins with maximizing consumption from the massive audience we've established through format innovation and ensuring that more creators in more places achieve success. Simultaneously, in collaborating with the podcast community, we are broadening our analytics capabilities, expanding Spotify for podcasters, and underpinning this effort is a continued leveling up of our advertising offerings and the introduction of more business models to help creators make meaningful money from their work. So basically, Spotify needs to be the platform that creators choose to use to monetize their business, whether that's through subscriptions or advertising, whether people are listening on Spotify or they're listening on another podcast app. Spotify really wants to be the place for creators. So what's the reason for this? And what's the reason for the job cuts? Well, let's go to the financial statements and look at exactly what's going on here. The trends: ad-supported monthly active users continue to go up. Ad-supported revenue growth, not all that impressive. 17% year-over-year growth compared to 26% year-over-year growth in ad-supported monthly active users. So Spotify is putting efforts into increasing the advertising that they're getting onto the platform. But as they're doing that and as they're focusing on that, they want to make sure that they can make money. If we look at gross margins, 25.2% basically haven't gone anywhere all year, despite pretty significant growth, 14% growth on the top line. Operating margins have actually gotten worse. Now, this includes things like stock-based compensation, which is a non-cash expense. But as investors are focused more and more on how much money companies are making, Spotify is going to have to make some tough decisions about what they're going to invest in and what those operating costs are going to be long term. I think this is just one step in trying to cut as much cost as they can and get as efficient as they can as a company. This is something CEO Daniel Ek laid out a couple of months ago in another round of layoffs that they had. And this is just finer cuts to the operating business and try to get to a leaner point for Spotify. So is this something to worry about or something to cheer? I think at the end of the day, Spotify becoming a more efficient business, a more focused business, is going to ultimately be really good for the company long term. Now, these cuts are painful, and I never like seeing them actually happen because I would rather see companies just redeploy workers to a different area. But sometimes that's not possible. And right now, the key for Spotify is going to be cutting costs as they're ramping up both their core business, the premium side of the business and also the advertising business. What we need to see long term is more creators choosing Spotify to be their core hub for creating a podcast or a video podcast. If creators are starting to move to that platform, that's going to be positive for the company and it's going to pull more advertisers in. So that's really the one metric that I'm going to watch is advertising revenue. And then on a secondary level, what is the gross margin on the advertising side of things? As they do fewer exclusive deals, which we also should see coming down the line, we should see that advertising gross margin go up from bouncing around break even single digits. We should see that significantly improve to 20, 30, 40%. That's what advertising companies are generally reporting in the tech space, and Spotify should be able to get there over time. If they can, this could be a phenomenal investment, but that's a big if. This is one step in the right direction, I think, but there's a long ways to go. So what did you think about this announcement for Spotify? Let me know in the comments section below. Don't forget to follow Asymmetric Investing. Thanks for watching, everybody. See you here next time.